Hi, I'm Jasmine, and welcome to our very first SEQ360 update. It's another way we can continue to connect with our clients, offering industry info and updates. And it's a platform we can showcase our full circle commitment to our SEQ family. Here's Bill with more.
Today, I'm delighted to be joined by Dr. Shane Oliver, Head of Investment Strategy and Senior Economist at AMP Capital. Thank you for joining us, Shane.
My pleasure, Bill.
So, Shane, getting down to business, it's been pleasing to see what looks like a broadly stabilising recovery in many asset class pricing, which obviously fell hard a few months ago with the commencement of COVID. A lot of things have happened since then. Our clients are invested across a range of asset classes, as you'd be aware and appreciate, including global shares, Australian shares, fixed interest, property, cash and the like. So, Shane, how do you see these various asset classes play out as the world continues to either live with COVID or eradicate it in either scenario?
That's a good question. We did see a terrible time in markets into March, and since then we've seen a pretty good recovery, particularly in share markets. My feeling is that recovery will probably continue, but it's not going to be as rapid as the initial phase. That huge rally we saw going from March to June was pretty much a recovery. I think going forward will be a lot slower than that, and we're going to have these occasional setbacks. But on a 6 to 12 month view, I think markets will do reasonably well. It is an interesting question about what's going to happen with coronavirus. I think either we go down one path where we learn to live with it. There are countries around the world who have managed it reasonably well, kept it under control, and when they have had outbreaks, they use a very targeted approach to control it rather than an all-in lockdown. And I suspect that's the way we're going to go. It's also worth noting, when you look at the US, when you look at Europe, when you look at Japan, even though they've seen second waves, Europe at the moment, US a month or so ago, even though they've seen second waves, the number of deaths haven't gone up nearly as much. And so it's proving a lot less deadly this time around, which in turn, I guess, is providing a bit more confidence. And we're not going to see hard lockdowns. We'll see targeted approaches, wearing masks, getting people to social distance. Areas that may have an issue might get closed down, with bars getting closed down. But I don't see a return to a generalised lockdown. Now, Victoria is a bit different. They've gone to an extreme. But I suspect the norm going forward in a world where we don't control coronavirus is one of learning to live with it and keeping it under control that way. The other one is where you go down a path with a vaccine. I'm reasonably confident that sometime in the next 12 months a vaccine will come along. A lot of good news happening on that front. It will take time to be deployed though. But against that backdrop, I suspect the global economy will continue to recover, not in a straight line. We saw almost a deep V recovery in things like retail sales coming out of those lows in April. It's going to be a bit more constrained going forward. Similar story in Australia, gradual recovery going forward. That in turn, I think, will underpin further gains in investment markets, particularly share markets. Ultimately, will help property markets, although I should note the property market tends to lag a little bit, and residential property still has more downside to come. One area where you're not going to get great returns is government bonds. Government bond yields down around 0.8% in Australia, even less globally. You have to expect lower returns from that asset class going forward. That said, if things go wrong, they are a good diversifier. So in that sense, there is still a case to have bonds in a portfolio. Yeah. But overall, if I look out next 6 to 12 months, I think things will be okay as the global economy traces out a gradual recovery. But of course, it's not going to go in a straight line.
And you see the world continuing on its path of growth and waking up every morning to a day of new opportunities and hopefully forgetting about how bad that coronavirus once was.
That's right. I think that's what will happen. If you think back to the last really big pandemic back in 1918, 1919, Spanish flu, and that was very debilitating for a period there, but the world eventually got over it. It did have some lasting impacts, and of course there will be some lasting impacts from coronavirus. We're going to be doing more communicating in the way we are at the moment. We're going to be doing more working from home, more online shopping, all that sort of stuff. They will have lasting impacts, but other businesses will come along to fill the jobs that were lost in the old ways of doing things. And I think we will get over it. And you should also bear in mind that if you got ultra gloomy in 1918 or 1919, you would have missed out on the Roaring 20s. So just because things feel a bit bad now at the moment, which they have been, doesn't mean that there's not a brighter future down the track.
So obviously long-term investors should be urged to not just look at the short term, as you say, turn down the noise and invest for the long term, and I guess keep diversified across a multitude of sectors, not just say shares or property.
Well, there's some key points there. I think, the tricky, unless you're prepared to sit in front of your screen and come up with a process to buy and sell shares on a daily basis, you're probably going to lose money if you do it. You've really got to have a process to do that sort of thing. So what you really want to do is focus on the long term. That's the way to make money in investing. The former head of Vanguard once said, why spend all your time trying to find the needle in the haystack? Just buy the haystack.
Buy the haystack.
Long term. That's how you will grow your wealth. If you're distracted by every piece of information that comes along, look at the nightly news. It's very depressing with all this stuff on coronavirus. I think it's incredibly important to turn that noise down. Watch The Bachelor. When it starts up again on Channel 10 or something like that. Just mind off financial stuff. Well, to be honest, that's what I've been doing. I've been watching The Bachelor in Paradise. You've got to turn down the noise, and diversification critically important. I think people tend to fall in love with this stock or that stock, or they love the banks, and then suddenly the banks run into some troubles. They can't pay their dividends. You've got to have a well-diversified portfolio to ride through those swings and roundabouts that are inevitable. But I think that the really important thing is to take a long-term focus. If you went short-term back in March, you would have missed out on all the recovery we've seen since.
Oh, that's excellent advice, and it really resonates with the messages that we're sharing with our clients to stay the long haul, remain diversified, use quarterly managers as well as index. And lastly, Shane, if I can ask, property. You touched on property. One question that we're being asked more and more at the moment is what the post-stimulus world will mean for property prices in Australia. And I'm talking residential property. And does property now pose a higher than usual investment risk, especially once interest rates might start increasing again? What are your thoughts on that?
Well, that's a good question. Australians have a love affair with the home, with
bricks
property.
And mortar.
It's the thing we talk about the most. I do think that coronavirus will have a negative impact on property prices, but I'd be more worried about Sydney and Melbourne. That's where there's been a lot of construction activity, a lot of supply hitting the market still. Vacancy rates are relatively high, and we're going to come out of this with a relatively high unemployment rate compared to what we've been used to over the last few decades, which I think will make it hard for some people to service their loans. There's also likely to be a longer-term effect from coronavirus, which, believe it or not, could be positive for some parts of the Australian property market, and that is this trend towards working from home. I think a lot of people have worked out that, we can work from home. Bosses have now come to accept it. That doesn't mean people are going to work at home 5 days a week, but you're probably going to get some sort of hybrid mix, which will mean that a lot of people will say, if you're in Sydney, where I am, say, okay, well, it's not too bad living in the Blue Mountains or the Central Coast because I've only got to go into the office 2 days a week. I think that's what we'll end up with. A situation where people aren't in the office 5 days a week, they're not at home 5 days a week, it's somewhere in between, which will enable people to live a bit further away from the city. Probably that's a negative for property closer to the city, reversal of a 20-year trend there in favour of city living. But I think it will help further out areas. I think it will also help regional Australia because a lot of jobs, if you work for, say, the NBN or a company, electronic company, you probably can do a lot of your job full-time from home, and that will boost regional Australia. So in some ways, I think coronavirus, yes, it could be a negative for the big cities, Sydney and Melbourne, where there's been a boom over many, many years that could unwind to some degree, but I don't see it as a big problem for regional Australia. In fact, I think it's good news for regional Australia. I guess the question is, should we worry about a property crash in Sydney and Melbourne? I don't think it's going to be that bad. I think low interest rates will cushion the blow there a little bit. At some point in time, yes, interest rates will start to rise. That will be a dampener when they do. Given Australians have so much debt, I don't think that interest rates can go up a lot. The Reserve Bank won't need to put them up a lot to get things to slow down again when the time eventually comes. But that's really an issue for further down the track.
But what I'm hearing from your insights is that the world's going to be a leaner, meaner, more agile and efficient corporate environment. And we're seeing. I mean, you're sitting in the comfort of your own home, talking to me. So it's a living example of what the world's going to likely look like. So
that's right. Very different to what we've got used to. I mean, there's this old saying from Lenin, the communist leader in Russia, that sometimes decades go by and nothing happens. Sometimes, a few days go by and a decade happens in terms of social change. And that's what's happening at the moment. Coronavirus has certainly shown, just almost overnight, that you can work from home. And you can do a lot of it from home. Now, and likewise, it's pushed a lot of people into online retailing. So that's going to have lasting impacts. But it's not necessarily negative. A lot of people think it's easy to look around and say it's all negative, but the reality is that I think people will have better home-life balance if they come up with some hybrid model, 3 days in the office, 2 days at home, or vice versa. And I think ultimately will lead to a far better quality of life.
Look, Shane, thank you very much for spending the time, and look forward to staying in touch. Thank you very much.
Thanks for having me on the program.
Thanks, Shane.
All the best.
Talk soon. Thank you.
Okay.